Okay. Okay. So today we are going to talk on weathering the downturn, a guide to investing in corrections and bear market. As we all know, what is going on in the uh, what's it called in the stock market right now. So that's why I chose to talk about this. And as usual, I won't spend much time on this. This is brought to you by Ivorian LLC. We do personal finance consultation, IT training, technical interview prep, and so on. So the agenda for today, we'll start with introduction, understanding market downturn, drivers of market downturns, notable market corrections, will the market recover, what not to do in downturns, strategic investing during market downturns, and then we will end with question and answer. Okay, so as we all know, yeah, this chart shows it's an all-time chart of the S&P 500 market index, the Dow Jones, and the Nasdaq. This is the all-time chart since inception. As you can see here, the market does not move in straight line. There are times of growth, there are times of decline. And even if I show you the market for a single day, you see that throughout the day, there'll be times that the price of, let's say, specific stock will go down, and then when it will go up. Now, there are times of, if I've been saying that, okay, the market does not move in straight line. It's always like, okay, there are periods of growth and declines, but there are also periods that there is a consistent decline, or maybe there's like a very, very sharp decline. So what do you do in times like that? You know, for some people, especially maybe people who are just starting to invest, they panic during that time, and they may make decisions that they may end up regretting. So it's important to note that there are ways to weather the market during downturns. And it's another important thing is that when there's a decline, nobody can tell for sure that, okay, this is how much the market will decline, whether 10%, 20%, and so on, or this is when the decline will end. Some people are going to speculate, quite all right. I once read an article that even gave a specific day and time that market will crash, but it did not. Because there are so many players in the stock market that a single person or a single entity cannot just determine what's going to happen, or when maybe there will be a turnaround. So because nobody knows when things will turn around, there are ways to go about, like to make sure that you don't incur too much loss. And there are things you can do that you will not end up regretting. That's why I scheduled this topic for today. Okay. Having said that, I've been talking about declines, I've been talking about downturns. What do all these terms mean? Like, when there is a consistent decline, what does it indicate? Now, declines, first of all, what's a market downturn? It's basically a period when the stock market experiences a decline. It could be as a result of, like, okay, maybe an economic activity. It could be as a result of something else. But anytime that there is a decline in the market, and I'm not joking when I'm talking, you see that I keep mentioning market. I'm not talking about just one stock. I'm not talking about just one sector. I'm talking about the whole market. A single stock could decline while the rest of the market is doing well. A sector could decline while the rest of the market is doing well. But my primary focus today is the whole market. I believe in one of our previous sessions, we've talked about bear and we've talked about bull as well. We said, okay, bull market is when the price of the general market just keeps increasing, when the price is rising. The bear market is when there's a fall in prices. And as I've known for since January, there's been some kind of volatility and decline in market, which became even more pronounced in the last 1 week or so. So we are going to talk about what to do in this time. Now, having said that, there are 4 major kinds of decline that we may need to be aware of. So we have market correction. You have correction when there is a temporary decline in the market, typically around let's say 10% from recent high. So let's say the market has been going on. And when I say market, how do we even measure the market? Like what direction the market is going? That's why we have indexes like what's it called? S&P 500, NASDAQ, and Dow. We use those. Those are just the 3 major ones. There are a few other ones, but those are the major indices that we can use to measure the strength of the market. So then, coming back to market correction, when there is a temporary decline from a recent high, a decline of about 10%, that's a market correction. You will often hear people say, when a specific when the market is just going up, people could say that maybe a specific stock is overvalued, or people could say that, oh, the market needs a correction. Market correction is something that happens often. Like it's a regular it's a thing that shouldn't worry you so much. And then we have the bear market, which is a sudden sharp drop in prices that could be up to 20% from the peak. A sustained drop that could be up to 20%. For market correction, the standard, the what you drop decline. For bear market, it's when there is up to 20% decline. Then we have market crash. Market crash is when there is a sudden drop, a sudden and sharp drop. Very often it happens within a short time. You can see that, okay, the market has been doing well. All of a sudden, something will happen, and one day the market could drop 10% in a single day. It could be like, okay, maybe within a week the market will drop 20%. That's a crash. Then we have recession, which is a significant decline in the economic activity. For recession, it's not just the stock market, it's the whole economy. And recession could usually last for longer than all these other declines. It could last for a few months or maybe even a year. It is visible in the whole economy, production. You see it in employment. That's when people start to lay off, and companies start to lay off, and they are no longer employing new people. You see unemployment will be high, prices will be high, companies will be laying off. That is recession. Now, what we are right now, we are not yet in recession. And this is not technically a crash because it's been going on since January. It just increased in the last 1 or 2 weeks. We can say that we are the border of between correction and bear market. So anytime we could enter the bear market. So what are the drivers of market downturn? What causes decline? What makes the old market to decline? There are so many factors. I'm just going to talk about a few of them. Number one is economic indicator. When there is persistent inflation, we know for a few years now, we've had inflation. The Fed has not been able to, well, they've done a few things, but they've not actually been able to bring it down to the level that is good for the economy. So when you see persistent inflation, when you see rising interest rate, when the GDP growth is going down, when there's no longer confidence in the economy, or when the economic activities are reducing, that could cause a decline in the economy, in the market downturn. Another thing is political events. Just like we have right, the tariff has made that has been levied on some companies has made the market to go down. That's an example of political events that could happen. But other things could be like political instability, policy changes, and so on. Then market sentiment. When people start panicking, when people start overreacting to things, that could cause the market to go down. Then sector-specific weakness. When a specific, you know, sometimes in January, there was this thing on DeepSeek, when there was the news about DeepSeek that, okay, they were able to develop an AI model that cost a lot less than American companies have been able to build their own. Because of that, the semiconductor industry like dropped. As soon as the news broke, for some days, the industry dropped. So now, sometimes when a specific industry is not doing well, it affects other industries, and it could potentially lead to the whole market declining. There could be ripple effect. When whatever happens to one industry could have a ripple effect on other industries. Another thing is like external factors, like maybe like natural disasters, a pandemic. We all know what happened in 2020. Around March, because of the pandemic, the market declined. So those are a few of many things that could cause a market downturn. So I want to show you some notable market corrections that have happened in recent years. As you see here, in 2022, the whole market, like the so this chart, we have a bar and line chart. The bar shows S&P 500 index for 12 months, the return, 12 months return. Then the line shows the inflation rate. I'm not going to talk so much on the inflation rate. I'll focus more on the S&P 500 12-month return. In 2012, there was a negative return. Sorry, 2022 rather. There was a negative return. We had in 2018 as well. Now you may ask that, okay, what about the decline that we had in 2020? Yeah, in March, between like, okay, March, April, May, there was a decline in the market, but the market was able to recover before the end of the year. So the net for the 12 months in 2020 was actually positive. So we had the financial crisis in 2008, when the market declined by almost 40%. Then we had like 2020 to 2022, we had the 1990, and we had the 1982. Now, why did I show you this? When I go to the next slide, I will still come back to this slide to show you a few things. It's important to look at what has happened in the future, in the past, to be able to encourage you about what is happening currently. Now, I understand that market downturn can be unsettling for investors. Nobody wants to lose money. When you open your brokerage account, you don't want to see red all around. But I must tell you, it's a natural part of the investing cycle. Like I showed you earlier, the stock market does not move in a straight line. And as you can see here, that occasionally we have negative return. But one thing you should notice here is that except for 2000 to 2002, every other time that we had a decline, by the following year, there will be a positive return. This is the only time that there was negative return for 3 years. And also another thing you need to notice here is that when there's a negative return, the following year, there is a positive return of more than 20%. So in 2022, we had a negative return. By the following year, we had more than 20%. Year 18, following year, more than 20%. This year 2008, more than 20. Every single time, the following year, we had more than 20% decline. Now, for this year, we don't even know if whether or not the market is going to recover. Again, like I mentioned, nobody can tell you for sure what is going to happen. Monday could come and maybe the president is going to reverse the tariff. Maybe things will start picking up. Or this could last for a long time. This year we could experience a negative return. It's possible. But it's important for you to know that the market always recovers from negative return, from downturns. And there are things you can do to make sure that your portfolio is not, that you don't lose all the money in your portfolio. And this, as the adage says that tough time never lasts. That's what you see in the stock market. Even though occasionally you see negative returns like this, it always recovers. And that answers the question here as well. Will the market recover? Apart from showing you here that the following year it always recovers, look at some of the major single-day market declines from 1981 to 2024. In October 19 of 87, on that day, there was 20% decline. It took 264 days to recover, but the market did recover. And 1 year return after that was 23%. Pandemic of 2020, there was in a single day on March 16, a decline of 11.98%. By 1 year later, return after 1 year was 66%. And so the only time here that the return was negative the following year was this 2008, that the following year was negative. And I believe I showed you some of the, okay, we can go back here. So the 1 year return after that, after this day, was 4%. Now, if you look at this, you could say that, okay, this is 2018, 2019 was 20%. Now, this 1 year return is 1 year from this day. That's not the whole of 2009. The whole of 2009 was more than 20%. But 1 year return from this date here was 4%. The 3-year return was 1%, 1.6%. So as you can see from here, the market always recovers. And I can tell you, even though I don't know when the current situation, when the market will recover from the current situation, I know for sure that the market will recover. Now, having said that, what should you not do during market downturns? In times of uncertainty and volatility, it could be tempting to just reallocate your funds and just say, okay, I'm selling all my stocks, I'm putting the cash in my savings account. Do not do that. And I'm going to tell you why in a moment. Do not do that. Do not reallocate. Do not sell your stocks because of what is going on. If it bothers you that each day you look at your brokerage account, you see negative, just close it. Just don't look at it. Just don't look at it rather than panicking. Because most of the time, when people panic, they sell their stocks during times like this, they end up losing. And I'm going to show you why. I have two charts here. I from Hartford Fund. Now, I've talked about a bull and bear market. The 50 best days, if you look at the 50, this is from 1994 to 2003 for S&P 500. The 50 best days of S&P 500 in terms of the growth, the increase. 50% of those days, meaning 25, actually came during the bear market. So during the bear market, when the price is going down, there are certain days when the price will go up. So 25 of the 50 days, best days from 1994 to 2003 came during the bear market. Another 28% came during the first 2 months of the bull market, while 22% came during the bull market. So as bad as the bear market could seem, there are still days when there could be growth, and you don't want to miss those days. If you sell your stocks, you panic and you sell your stocks, you are going to miss those days. And what happens when you miss those days? Let's look at the second chart here. Again, from 1994 to 2003. If you miss the best days, if you stay invested, let's say you put, I believe, 100,000, 10,000. If you put 10,000, you invested that. Sorry, I don't remember if it is 10,000 or, yeah, it's the growth of 10,000. So you invested, let's say in 1994, you invested 10,000 in S&P 500. And you stayed invested through all the declines. By 2023, you will have 181,000. If it means the best 10 days, you will have 83,000. Look at the difference from 181,000 to 83,000. If you miss the best 20 days, you have 48,000. You miss the best 30 days, you have only 30,000. So one of the best things to do is to not panic, is to not reallocate your stock into a cash position. Another thing is even inflation. So you think you don't want to lose your money, you sell your stocks because there's a decline, and you put the money, you just put the money in your account. You keep it as cash. You are technically losing your money because of inflation, unless you have maybe like high yield savings account or something. So it's important to not panic. A second thing not to do is timing the market, which also follows reallocating cash to funds. So what some people will do is that they will say, oh, I don't want my money to decline more. I don't want to lose all my money. They will sell their stocks, keep cash, and they will be thinking that, okay, by this time, the market, the correction will be over, then I can buy back. You will never know. I think it's in one of the previous sessions, I talked about one competition I entered when I was in school. I wrote an essay on when you see a bandwagon, it's too late. And that essay, like, it helped me not just that, okay, I entered the competition. It helped me, especially in investing. When you see a bandwagon, it is definitely too late. The stock market will not tell you the day it's going to increase, the day it's going to grow. If you are trying to time it, you could actually miss from the best days, from some of the best days, just like I showed you here. So no single person can time the market accurately. So saying that, okay, you want to get out and then you come in later may not be a very good strategy, especially when the decline has already started. So those are two important things that you should not do during market downturns. So having said that, what do you do? How can you make sure that you don't lose all your money? And let me tell you, I say this not to make anybody panic. At least I've been saying that do not panic. But some companies, some stocks will not survive this. I have stocks that I bought that became zero. And in the stock market, if anybody tells you you're not going to lose money in the stock market, the person is lying. You lose some, you gain some. The most important thing is that you should gain more than you lose. Because even if you are the best investor in the world, there are things that will happen to you or to the stocks you invest in that are beyond your control. 4 or 5 months ago, we would have known that we will be in the situation that we are right now. 2024 was a very good year when it comes to the stock market. So, again, some stocks are not going to make it out of this. But what can you do so that you don't lose all your money? While you may lose some money, you will not lose all your money. And at the end of the day, when this period is over, whatever loss that you have incurred would be reversed. And remember, we've talked about I forgot this concept that you don't actually, you may see a decline in your we've talked about realized gain and unrealized gain, realized gain, unrealized loss, realized loss. When you see red in your account, that's unrealized loss. You don't actually lose the money until you sell your stocks. So if you leave it there, if you don't sell your stocks, by the time the market bounces back, all the gains will be, all the losses will be turned to gain. Now, let's go into some strategic things that you can do to make sure that you don't lose all your money. The first thing is to engage some risk management techniques like diversification. For diversification, you may, if it bothers you a lot, I would recommend that leave your stock, don't even sell it at all. But if it bothers you a lot and you need to reallocate funds, I would say don't keep cash. Rather than doing that, maybe you want to try some alternative investments. Maybe things like bonds, maybe things like high yield savings accounts, maybe certificate of deposit, share certificates, things like that. Or maybe you want to invest in foreign markets. We know that, okay, American stock market is doing this, but there are some foreign stocks that may not be as impacted as American stocks. Maybe you want to do that if you must reallocate your funds. Well, when I was talking about diversification, I've actually mentioned asset allocation as well. about like, okay, moving things. Well, another part of asset allocation is this. Not every sector is affected equally. There are stocks that, okay, they may also be affected, but not as much as the others. Like, for whatever reason, people will still go to Costco to buy, will still go to market to buy things. So maybe you may want to reallocate your assets into other ones that may not be as affected as the others. But just you need to be careful and just be strategic. Then liquidity management. Now, okay, you have what's it called? You have some money right now. So again, even though we are in a market decline, what I'm talking about today is not just about the stocks that you already have. I'm talking about maybe you invest often. Maybe you invest, let's say, like every month, every week or something like that. So the cash that you continue to generate, now that there is a market decline, what do you do with it? Maybe you want to keep a little bit more cash than you have been keeping, but I will not say keep everything in cash. I will still advise you to continue to invest. In actual fact, during market correction could be a good time to buy more of some stocks. But be careful when you are buying more of stocks. Like I mentioned, some of them are not going to recover. Look at stocks or look at industries that you know that they, no matter what, people will always, the companies or such industries will always be profitable. Now, maintaining long-term and term perspective. I always say something, at least that's what I practice. I don't put money in the stock market that I cannot afford to lose. Because I don't want to wake up in the middle of the night and start thinking that, oh, I lost my money. I don't want to, don't get me wrong, I don't want to lose money. But I put money in the stock market that if for whatever reason I lose it, I'm not going to kill myself for it. And also, I don't put money in the stock market that I need in the next 1 year or 2 or even 3. So when you maintain long-term perspective, if the reason you are investing is for retirement, then there's no need to worry yourself about what is going on in the market right now. Because no matter what is going on, no matter what happens in the market, the decline will not continue for the next 10, 20 years. So maintaining a long-term perspective could also be good. Now, practical approach, like value investing. You may want to, again, this is for if you still have some cash or you keep generating cash that maybe you want to continue investing. To continue investing, you may want to look at stocks that are undervalued. Do fundamental analysis. The last time we talked about technical analysis, we talked about fundamental analysis. You can be able to, when you do certain research or you subscribe to certain publications, you can identify the stocks that are undervalued. And those are the ones that are good to buy. Another thing you may want to do is dollar cost averaging. So you have some money that you want to invest. Maybe you don't want to invest it all at once. Maybe you want to invest like some a part of the money now, wait for another week, invest again. So if you invest, let's say for example, you have 5,000 that you want to invest. Out of the 5,000, you invest let's say 1,000 or 2,000 today. Let's assume today is a trading day. You wait a little bit for a few days or for a week, you invest another 2,000. If this market declines further, you make use of that opportunity to buy at a cheaper rate. So basically, dollar cost averaging is when you consistently invest in the stock market over time. And when there's a decline, you take advantage of it. It does have its own disadvantage as well, because it could go the other way, that the price will go up. But it helps a lot when there's uncertainty, yeah. So you may want to try that. Then defensive investing, I talked about that briefly in the last slide. That stocks that they always do better than the others during the downturns. That doesn't mean they are not affected at all, but they do better. For example, no matter what is happening in the economy, you will still use energy. You pay for your electricity, you will use electricity, you will use gas. You will still go buy groceries. So industries like that could be good to invest in. Then alternative strategies. Now, you need to be careful with this. Some of these, I just want to show you these. Some of these I don't even do because they are risky. While you may make money from them, they are risky. So before you try anyone, especially the first to hedging and short selling, before you try this, you may want to make, you definitely want to do necessary research. Now, alternative strategies in hedging with inverse ETF. What is inverse ETF? We know we've talked about ETF, but one day I will have a session on ETFs and mutual funds. ETF stands for exchange traded funds. Those are like basket of stocks. It's just as if you go to, let's say, Sam's Club. Instead of buying oranges, you buy mangoes, you buy banana separately. They sell baskets of fruits. You just buy the basket and it already contains different kinds of fruits. It's the same thing with ETFs. One ETF could have 10 stocks, could have 100 stocks in it, even more. Now, there are ETFs called inverse ETFs, meaning there could be ETF of, could be regular ETF of, let's say, a specific sector, let's say, for instance, semiconductor ETF. There will also be inverse for semiconductor. How does the inverse ETF, how does inverse ETF work? When the regular ETF or the stock is going in one direction, the inverse will go in the other direction. So actually now that when the market is declining, when regular stocks and ETFs are declining, the inverse ETF will go up. So that's a strategy to make money, but you need to be careful with that. You could lose a lot of money. Then short selling. Short selling is when you believe that the price of a specific stock will decline. You could actually borrow some stocks and then you sell them. You buy them back at a lower price and thereby you make money. But again, you can't actually lose money if it goes the other way, that you will have to buy at a higher price. So if you are going to try any one of these, make sure you are well trained. Then reinforcing portfolio fundamentals. Rather than just saying, oh, okay, the market is going down, I'm just going to buy more of a specific stock now, and then maybe next week is going to go up and things like that. You may want to do some fundamental analysis. I talked about that a little bit earlier, about looking for stocks that are undervalued. When you do, what I'm trying to say here is that don't just buy stocks because they declined and you think that they will grow again. Do the necessary fundamental analysis. Make sure that the company is a good, the stock is a good one. Make sure it meets certain criteria so that you can be sure that, okay, eventually when whatever is happening in the market reverses or the market recovers, that stock is going to recover. So okay, that is it for today. So we have a few minutes left. Any questions or contribution? Anything that anybody would like to contribute?
So I have a question. It sounds like with what is going on in the market, things can go up, things can go down, and you've talked about different strategies, especially let's say if I want to buy more, I should do research and all that kind of stuff. I don't know if this is what I'm hearing. Are you suggesting kind of taking the middle ground whereby you are being careful not to buy too much and also not to sell too quickly? Is that what I'm hearing?
You could take that. That's actually a good approach. You could take that. For example, I still, with what is happening in the market, I'm still investing. But I'm not investing as much money as I used to before the market started declining. So I'm being careful because, like, for example, well, this whole thing started in January and I kept investing, thinking that, oh, it would soon be over. I kept investing. The money I've invested in the last, since January till now, all the stocks I bought since then, they are negative, right? But the good thing is that since I know and I don't know for sure when this is going to end, I'm not going to just put all my money there. I'm being careful so that the money I have, I'm putting some money there, but I'm also reserving some money. If it declines further, then I'll have the opportunity to buy more. So yeah, taking like a middle ground could be a strategy. Yeah,
Thank you.
welcome. Another question? Anyone? Questions, contributions, anything? Okay, there's no question or contribution. We can end this.